All right, looks like we're live. Hey, everybody. Exciting day today. A lot of things that we've been talking about on this show are playing out now. Let's start with QQQ. This super liquid ETF. I thought about buying some puts on QQQ today, expiring Friday, but I didn't do it because I've already got a lot of exposure for the market going down. As I look at this chart, a few things jump out at me. One is this looks like a topping pattern. It looks kind of like maybe like in 2010 what the chart looked like, and that's not really surprising. Chris and I talked about this last night, that after the 2009 bottom in SPY and QQQ, a lot of the stocks and the business development corps and things like that, after about a year of time since the crash, they got hit pretty hard again. It's kind of like an echo drop because the long-term capital gains selling kicked in, and so we may be looking at front running for that selling happening now. So what you're seeing on the chart right now, I've got this up. This is it's a 1-year chart of QQQ, and you could see that anyone who bought between late February and April, even into May of last year, and look at all the volume down here. I want to call out the volume on this chart. Huge volume coming into the market. And a lot of that's turnover. It's shares changing hands. And a lot of that fell into strong hands. And as they come into a long-term capital gains situation, and they're up like crazy amount, like 50%, 75%, and on some of their stocks, hundreds of percent. These kind of crazy gains, a lot of people are going to lock it in, or they're going to move down on the risk pyramid, if you want to call it a pyramid. They're going to move away from some of the risky stuff that they were buying and moving into safer stuff, and with the idea of getting back into the risky stuff at lower prices, or at least after a sell-off. So it doesn't even have to be lower price than now, but after a sharp sell-off. So if we look at this, some of the high volume periods in this chart, the lockdown crash is crazy volume, obviously. And then in September, there's a big volume too. And the volume that we're seeing now, again, these are like negative volume patterns. It's what you see going into a down market, but it doesn't mean that it's going to be a down market. So I do a lot of modeling on ETFs and time series data, and a lot of what I'm looking for is these kinds of signs. If we see enough of these signs and we line them up, do they give us an idea about what we can expect as far as, like, I don't care if a crash doesn't happen, but I don't want a crash to happen and me not have a heads up about it. And so when I see a series of short-term lower highs and lower lows, that's a sign. When the market is sagging and rolling over, and it's now trading underneath moving averages, that for the most part it was over those moving averages really for the bulk of the last year. It's now below. So if you look right here, I'm going to call out, I have this box of data here in the upper left corner of the chart. And I'm not just looking at the lines for these moving averages. Some of these lines I don't even care about, other than that I can see what those price levels are. And you can see that for QQQ, it's below the 5-day EMA. It's below, and the 5-day EMA is below the 8-day EMA. These are exponential moving averages. And the 8 is below the 9. That's a downtrend. And these are all below the 21. So I mean, this is, it's looking ugly. The 21 is still above the 50-day simple moving average. However, that could change as soon as tomorrow. So I know I've been talking a lot about ARK lately on the show, and I left I left yesterday's title in the show. I'm really bad about adjusting that, so I'm still pretty new at this streaming thing. But anyway, in yesterday's title, I talked about drama with ARK, and I was shocked today actually that ARK Innovation ETF was down even more than its top holding, which is Tesla. So let's take a look at that real quick. So whatever's going on in Nasdaq, it's going on in a way bigger fashion in ARK than it is in Nasdaq, including the volume pattern. So as ARK went through the lockdown crash, at that time there wasn't necessarily a whole lot. We're not seeing the kind of volume that would indicate inflows or outflows. Like, it was just business as usual at ARK. And so ARK did a smart thing what at the time was a smart thing. It was moving out of their safer investments and into the higher risk investments. And then when the market turned around, ARK took off and it ran for a long time. And so the people running this fund, Kathy Wood and others, saw the benefits of doing that, and it reinforced probably for them that was a good idea. But in doing so, it's a two-edged sword. So where they get hurt is when outflows do come, if you've already moved from liquid things into illiquid things, then in order to handle the outflows, at that point you have to liquidate the less liquid stuff. And that can cause a feedback loop, or as others say, a doom loop. And so we may be seeing that in ARK getting started now. It looks a lot like the NASDAQ chart, but it was up more and now it's down more. Chris and I have been talking about this on the show for really like 2 weeks now. And there's a lot of people tweeting about it. It's not just me. Samantha LeDuc on her show, she's been talking about this too. So there's a lot of places to follow this story. And this is one of them. So I've been looking at her trades and the strategy. And what I have done, I'll just quickly review this again, is I sold some, I bought some Iron Condors on ARK, which basically means that if ARK moves like it normally moves, and then those Iron Condors are going to earn an income. But if ARK crashes or it soars, the Iron Condors lose. And so what I did is I took the credits from the Iron Condor and I didn't just bank them. What I did instead is I bought deep out of the money puts on ARK and on bear put spreads on ARK's biggest holding, which is Tesla. And so today ARK is down 6%, and in after hours it was down even more, although not a lot, not dramatically so, but maybe 6.5 or 7% down for the day. And then looking over at Tesla, I thought Tesla would be down more, but it was actually down less. However, this chart looks pretty bad. The volume pattern isn't as bad. So I'm going to pause on this chart for just a minute and talk about this glorious beer that I have tonight. This is so last night I had a non-alcoholic beer. Tonight I have this is called Dragon's Milk. It's 11% beer. It's pretty cool. The cap on it has this cool dragon, and it's tasty. Their whole thing is bourbon barrel aged stout, and it's got a cool little bit on the back. I guess you can feel like you're in a Game of Thrones episode while you enjoy the beer. I don't know. Anyway, so back to Tesla. What I put on is so when it first fell under these moving averages, Chris and I were talking about this on the show, and I was watching it and shorting it pretty aggressively, and it had this big fall. And I said, Chris, I think it's not going to keep going down just yet. I think it's going to bounce up to those moving averages. And it did so. It did it in a way that was a little surprising to me as far as the timing. But by the way, in a more bearish fashion than what I had forecasted. So off of this low at 619, I thought that Tesla would essentially trickle back up to the 50-day, but it couldn't even do that. And now it's rolling over again, and zooming in on these charts, it's really, really nasty looking. So, I mean, just all for the last 2 days, it's just straight down almost every single day. Very little relief in there for holders of Tesla. I watch this YouTube channel called Meet Kevin, and he's had a lot of Tesla guests on. He's a big holder of Tesla himself. Kevin is. And I mean, these folks they're like diehard Tesla fans. So they're not selling their shares, but they're already bought in. They're not buying more shares either. So they're waiting for me and you and people who are maybe a little bit more skittish to come in and push the shares higher. But my take on it, my read at this point is, especially with the Bitcoin purchase, is, you know, they've kind of done all the creative shenanigans or financial engineering that they can do on this. And in my area, people aren't really driving around Teslas. I mean, I see a Tesla maybe, I don't know, once every week or two around here. And so where I'm going with this is, I think that there was a lot of battery tech innovation driven by Tesla and its investors, and that has changed the world. But I mean, I think that battery innovation, you know, that's happened. It's sort of like the early investors in the internet. You know, the first few to invest made a lot more than the people who came later, but the people who came later were important, and their capital did help build the internet. But at some point, that capital just wasn't needed anymore. I mean, the internet was largely built, and what was great about it was there, at least for that time. And it needed time to kind of reset from a financial and investor perspective in order for things like the cloud technology to come along and add to the story of what we know as the internet. It was really two things. It was miniaturization in computers, which was, we saw that from Apple in their iPhone and Google with the Android. And so the mobile phone usage was a big driver for cloud compute. And then the seasonal demands for Amazon, right, was a huge driver for the innovation that led to cloud computing. And so I don't know if it's a word for it, but can we call it Internet 2.0 is the cloud computing and self-healing networks and things like that. I mean, these were just a pipe dream in the 90s, but I mean, now it's everywhere. There's zero downtime deployments and the self-healing software and 3 nines of uptime, 5 nines of uptime, whatever. I mean, you know, it's high availability internet software is out there. So where I'm going with it is maybe we're seeing kind of the limits of this wave of innovation and what the investment dollars can bring to this space. So I want to step back for a second and look at, just quickly recap something that Chris and I were looking at yesterday was TAN. And this is the solar ETF. And if you zoom out far enough, you'll see that this thing has these waves, like, you know, where it's, if we go back before the 2009 thing, well, I guess, you know, this ETF doesn't go back that far, but let me set this back to like a 5 par size. Anyway, the point is, this thing moves in waves, and we may be seeing kind of the limits of this wave of investment. And the reason solar is up is because of innovation in battery technology. And if you look at the volume, it looks like it's kind of like out of gas here, maybe. And if we look over at LIT, this is the lithium ETF. This is also battery tech. So I'm not saying it's over, but I'm saying, like, it had a huge wave. There's been a lot of innovation. And it may be that what they can do, at least with, what's the low hanging fruit that investment dollars can help them reach. It's kind of already there. It's the word's out on the street. More advertising dollars for Tesla isn't really going to help them sell more cars or innovate in technology anymore. And science needs time to bake in the oven. So I think maybe we're kind of at some limits here. I don't know if that's what's going to happen or not, but there's certainly exuberance in the sector. So looking at CCIV and these SPACs, zoomed way in on that. You can see how short-lived this thing is, just a few months on this chart. So, look at this thing. It was so strong until suddenly it wasn't. And I think that this is a leading edge for what we can expect of the electric vehicle space right now. Is just explosive energy, high excitement, investors that are keen to get in on the next big thing, and they're true believers. They're gonna hold. Again, I was talking about the interviews I've been watching on Meet Kevin. He's bringing on some really great guests, and they talk about the bright future for that space in technology, and it's exciting. But do I want to be the 100th or 1000th or millionth investor to step into that arena? Or do I want to be investing in emerging trends? And my answer is always going to be I want to put money where the emerging trends are. And so for when it comes to the electric vehicle space, the only one that's interesting to me right now is it's not FSK. I did this yesterday. FSR. Fisker, Fisker. So it was down hard today, 13%. But I'm in this with I call it a swoosh position. I'll show the exact position I have. But it's essentially a what I would say a medium dated call with at the money, with a short dated, slightly out of the money put as protection, and I roll the put. And so anyway, we can look at that. I'll just showcase the position I got in Fisker, and I did it on a dip. I did it actually on the low of this bar, around 26 is where I put that position on. And, it shot up. I was feeling great about it yesterday, and then today it's like, well, good thing I have that put. So let's take a look at FSG. And I'm not just here to talk my book. I could close this position tomorrow. Oh, it's FSR. Sorry. I don't know why I can't get this ticker symbol right. They did not do a good job with the ticker symbol. Okay, so what I have is an August 25 call. And as a combo, I have the March 9th 24 put. And so when you look at it on the simulator, here's what it looks like. I call this a swoosh position because when you look at it on the simulator, it looks like a Nike swoosh. And I'm on this dotted line. The solid line is if I hold it all the way to expiration. When the nearest term option in the combo expires. However, my plan is essentially to keep rolling this put and keep it about 2 to 4 weeks out. I don't want it to come in less than that, and here's the reason. Let's just actually look at that real quick. So if I skip ahead to the weekly expiration, today is March 3rd, 2021, and so next Friday, or this Friday is the 5th, the following Friday is the 12th. And so if I go to the 5th, and I say, okay, here's this dotted line is where I can expect my position to move, assuming that there's not much changes in implied volatility. And so you can see that if Fisker doesn't really move, it stays around where it's at, then I'm going to lose a little bit of money. But if it goes up, the put becomes worthless almost. And that's the idea. But the call I have with long, it's got a long calendar on it, becomes valuable, quite valuable. And that's the idea. And if the market crashes, then I'm covered too. If it doesn't move, then I'm mostly paying time decay on the put. it's not really coming from the call so much because the call has, first of all, has a lot of time on it. So there's not much time decay based on that. And second of all, because the call is at the money, at least around the time where I'm putting my capital in. And so if we look at, a 20% down move, by having this 3-week output, if Fisker is down 20%, I'm fine. If it's down 40%, I'm fine. But you'll see that if I try and buy short-dated protection, it doesn't protect that call as much as if it's a little bit further out. So what you'll see is that it makes a much harsher triangle. If the put is going to expire within a week, for example, let's say, then it's the simulator resembles more like this solid line than the dotted line. I want to be on this dotted line. I like that. It's comfortable to me. So let's scratch this March 19th put, and let's actually just bring it in on the calendar here to March 5th. And so this actually looks okay because it's not super expensive. But what happens is if I go to March 5th, you'll see that it burned up more money. See that? And I have to roll it. So, it's if the price stays where it is, this put burns up faster, and I don't really like that. So, I mean, you can play with it and get a feel for what you like, but for me, keeping it about 2 or 3 weeks out works best. And so, if I go to March 5th, see how it burned less. It maybe protected me a little less in this case, but generally, it tends to protect the call pretty well. So anyway, that's Fisker Group. That's the only electric vehicle position that I have on the long side. Probably if I was smart, what I would have shorted instead of Tesla was the Chinese knockoff NIO. I mean, look at this thing. I mean, it's when it is falling apart, it's really falling apart. In fact, I'm probably going to buy some puts expiring Friday on NIO tomorrow because I think that we're ripe for a really nasty shakeout. And so let's take a look at what we can expect. I mean, I think that as far as NIO goes, the thing I don't like about it is you don't get anywhere near the bang for the buck as far as commission and bid-ask spread on the options for NIO because the liquidity isn't quite as good as Tesla. And I'll show that here. So NIO has 580,000 options contracts average daily volume. That's pretty good. But if you compare it to Tesla right now has over 1 million average options volume. And each contract is worth so much more. So, I mean, the share price for Tesla is 15 times higher or something than NIO. And so you get a lot more bang for the buck out of the options contracts. But something working against NIO is, one, the accounting standards for Chinese companies, in my view, is, I don't hold it as high of a regard as for U.S. companies. And so they can maybe paint a rosy narrative on paper a little longer and maybe for maybe a little bit tell a little bit of a taller tale with Chinese companies. And I've talked about examples of that. One is the Luckin Coffee, which is it's the Starbucks of China, which now trades on the pink sheets. So anyone who bought that story is really kind of stuck. Now, NIO might be a great company. And for people who have those shares and believe in the story, I mean, I'm not trying to say anything disparaging towards them. But just in general, I'm more skeptical of Chinese companies. And so that brings me to a stock screener, which I invented this week. It's this: China and shortable, and also optionable. And that's the screener. That's it. The other thing that I've done here is I put a sort on it. And the sort was performance for the quarter. We're looking at the things that are up the most for the quarter. And then I go to the charts view. And it preserves the sort order when you go to the charts view. And so yesterday, Chris and I talked about this one, the 9 Limited. Well, this is a company that's making cryptocurrency acquisitions. And so it's a Chinese company. And shockingly, they have less than 70 employees, at least that in the data that's published to Yahoo Finance. So that's interesting. And as I look through this list, I mean, I see a lot of these things spiked and are now kind of fading. Like look at Tiger. This was the big up and coming thing. And then, I mean, a lot of them are already on the way back down. And so let's talk about GameStop, because these all spiked right around the same time as GameStop. I did want to talk about GameStop today. I have a position in GameStop. I am long a short-dated bull call spread. What I have right now is the 150-200 bull call spread expiring this Friday. And I think it actually looks like it's making a bull flag here. Like, if GameStop was weak, it would be all the way back down under 40. But it's not. And so I think the folks who are squeezing this may feel like there's still some more juice left in here to squeeze. And how far it goes, I don't know. I'd much rather have an open-ended call option in GameStop than a bull call spread, except for the fact that the implied volatility after this new pop right here is just so high that I think maintaining this position as a bull call spread, at least for now, is kind of the prudent thing. Like maybe if it spikes down at the open, what I may do is just cover the short leg, and then now I'm long just the 150 call, and then I may roll that out to next week, and maybe I might have to roll out and up. I don't know, but so if we zoom in, that's really what I want to keep an eye on GameStop is the 30-minute chart looks constructive to me. And I actually got in too soon on this and then waffled around, lost a little bit of money on this dip, and then got back in near the end of the day here. I got in on this first up bar, and glad to see this second up bar. So, I mean, there's a resistance level here at like 135, 134, something like that. And it may stay under that all the way through the week. So that bull call spread may go nowhere. I don't know, but it got cheap enough. And again, there are ways to roll around in it. But zooming into the 10-minute chart, it looks good. Looks good to me anyway. See volume coming in at the end of the day. And the other thing is it fits with the narrative of a VIX spike. I mean, I think that VIX is maybe overdue to spike. So let's talk about VIX a little bit. I haven't been talking about it as much. I mean, that looks great on the short term. Somebody was asking in the comments to a video earlier, like, hey, would you buy UVXY? And I'm not in UVXY because I'm playing it a little differently. But if I didn't have a whole bunch of puts all over the place, then probably, I would consider getting UVXY. So, and Chris has a position in UVXY also. So I was hoping he could come on today and talk about that, but the timing just didn't work out. I told him he could call in if he gets my message in time. So we may still hear from him about UVXY. Let's talk about the VIX futures forward curve just a little bit, because when VIX gets moving, there's a few things I'm looking at. I'm looking at short-term trend on VXX because it trends. And it also mean reverts. It's a really weird thing. And the trend, I mean, like it still looks stuck in the mud on a daily chart. A few reasons for that. One is financials. Two is energy stocks. And three is there's like a big drag on long-term treasuries it's kind of like keeping the market up, because if money were flowing into bonds, it'd be flowing out of stocks, and we're not really seeing that yet. I actually rolled my TLT back spread that I talked about yesterday. I rolled from 141 call at the center of that back spread down to a 139, and we can talk about that later. But let's stick on VIX for just a minute. So what I have here is, this is VIXCentral.com, and I try and look at this just about every day. I mean, you don't have to look at it every day, but keeping an eye on it is a really healthy idea. And I'm reading Michael's comments here. So he says, Meet Kevin is one of those YouTube guys that try and sell their books, and online they are not rich from stocks at all. Is it possible to lose money on a put option if the stock goes down? Yes, it's possible to lose money on a put option if the stock goes down. In fact, it happens to me all the time. It's where if you run out of time, like if you buy the put option out of the money, and you run out of time, then yeah, you can lose money on it. But yeah, I agree with me, Kevin. His channel, like, he's got it over monetized. He's running commercials every like 5 minutes, and it's super annoying to multitask while I'm watching his show, because I just want to like click past all those ads. And so I don't tune in all the time. But I mean, he does have some good content. I think he really made, his bread and butter is real estate, but that's less exciting to talk about since the COVID lockdown. And so, talking about stocks became the hot thing, and real estate became, weird. So sort of like that Dave Portnoy guy who was like a sports betting guy, flipped over to stocks. And people like me who've just been around forever, like, we see these guys and we're like, yeah, I mean, their personalities, they're really cool personalities, and they're fun to listen to. And I love that they're bringing attention into a space that I care so much about and I'm passionate about. But at the same time, it's just like, it does come across as kind of like, let's just say that they don't hold the most mature views. And now I see Dave is pushing this ETF Buzz, BUZZ. Apparently it just came out, and I think he's invested in the fund that's launching that ETF. And people have compared it to like a milquetoast MTUM, which is the momentum ETF. Before I flip over to that, let's go take a look at Buzz. That'll be fun. Let's talk about this VIX term structure. So right now we've got the tiniest little bit of backwardation, and this is S&P 500 VIX. And the real pressure right now is coming from ARK and the NASDAQ and a lot of the high-flying tech and biotech companies. And so the S&P 500 has been largely shielded because of strength in financials, because of the wide yield curve, and oil and energy stocks because of the reopening news. Like we saw Texas and Mississippi announcing that they're getting rid of the mask mandate. They're leaving that behind. So that strength is helping to hold the S&P 500 up. Now, there's a battle right now going on. And if you ask me, my view right now is I think that panic from the tech sector is going to spill over into those other places. And that I think that the lever being used to drop the stock market right now, and ultimately I think it's going to stop the decline in TLT when the stock market starts to bleed out. That's a lot of money getting shifted over into a less risky asset class, which is government bonds. That will kind of stop the TLT drop that's been going on. So we see a tiny little bit of backwardation there. When I talk about backwardation, like you can see that the green line right there is spot VIX index, or it's the VIX index is 26.67, and the front month futures contract, which is the March contract for VIX, is trading at 26.65. So tiniest little bit of backwardation. but the curve is not inverted. And so there's still a big down pressure on VXX, because what they're doing is, as we get closer to this March contract expiration, that fund is literally selling out every day of their March contract. They're taking the sales proceeds and they're buying the April contract. And as you can see, like, they have to pay, whereas they're only getting $26.65 for every March contract they sell. They're well, I mean, I'm putting that in dollar terms. It's a little different than that. But anyway, the point is, like, the sales proceeds they're getting based on the contracts they're selling for March is 26.68, and they're having to pay 28.16 in order to stay fully invested in the VIX product space. And so, like, they're always just reinvesting all the money at the front month and rolling it. So, you know, it's they're doing it day by day. There's every day they're selling a little bit of the front month and buying the second month out. And they may have altered it in the prospectus. That's the way it used to work. It may be that over time they've had to alter that. So I don't know. My information might be a little bit outdated. And so, you know, if that's true, I apologize. But if you're really interested in trading the VIX stuff, then, you know, I encourage you to go familiarize yourself with the prospectus. So, you know what? As we're watching that, the backwardation just disappeared. This was 26.65, and now it's 26.67. So, that's funny. Now there's technically nothing but contango on that curve. So, when this VIX futures term structure moves into backwardation, I mean, it never holds. It won't hold forever. But while it does, then that can give an upward an anti-gravity or upward drift to VXX. And we saw that during the lockdown crash, where VXX soared last year. Let me try and bring that chart up. Why is this not showing very long? All right, well, let's look at weekly. There we go. So during this rip in VXX, where it never really fell below its 5-day EMA. And so what I was doing on this whole way up, just knowing that everything was going bonkers because of this lockdowns, I was essentially like selling these rips and buying back the position when it got close to the 5-day. And I did that like the whole way up. And I was not trading options at that time. But I was trying to hedge my long positions, which was almost impossible. Like, it was crazy. But that was really fun trading. It was super active chart. It was pretty easy to read at that time. And you could kind of scale in, scale out, and use trailing stops, and everything was super liquid. And it was fun trading that in VXX. As for, like, you know, is UVXY the place to go right now? Well, maybe if you're not trading options and you take the view that some of this big tech could lead to a 1987 type of crash right now, or a 2010 flash crash kind of scenario. I mean, it's certainly not out of the question that we may be facing such a scenario. I mean, we talked about the doom loop with ARK. Well, there's no way that the NASDAQ escapes from that unscathed. What's up? Okay. Micah says hi. She probably wants me to wrap up the broadcast soon. But I still have beer, so we're not done yet. For anyone just tuning in, this is the Dragon's Milk beer. It's pretty good. All right. So what next? Gamestop. We didn't talk too much about that. So let's actually take a look at the options position I have in Gamestop. And I already talked about why on the chart that I put it on, but let's actually look at the position in the simulator. This is a really helpful thing. This is akin to backtesting. So I have the 150-200 combo. And it looks like this. Let's actually zoom this out because the range for GameStop is large. So if GameStop, so this is important. The return to risk, like expiration is this Friday, and so with 2 days to go, if GameStop rips and holds above 200, then I'm looking at 14-1 on my money if I'm in near this price here. So, I mean, I like that. That looks like good odds. If I were to just put on the 150 call, I mean, the odds that it's going to hold like way above 200 is low enough that, so let's look at a similar thing. Like for this one, the ask is 325. So if we're going to spend the same amount of money on just outright calls, you'd have to be coming in right here at the 175, which means that in 2 days, by Friday's close, you need GameStop to be not only above 175, you really need it to be above 180 before you even have any profit. You need it to be above 178. So, I mean, that's a lot lower odds than it being above 153 in my book. And so that's the reason to use the bull call spread. And the other thing about it is, you know, you can see I'm using the really super short dated stuff right here. And the reason is I want the most bang for the buck. Like, you know, at the end of the week, I can roll what I have into next week, or I can just wait and put on something fresh next week. Like it gives a lot of flexibility. The other thing about it is, I mean, time decay works the fastest in the last few days, and that can work for you or it can work against you. And so where it works for you is two ways. One, if you're a premium seller, and two is if you are a claim buyer like me on this trade. And when I say a claim, like think about buying car insurance. And what I'm insuring against right now is that I'm basically laying out a premium payment. So somebody else collected this premium from me of per spread. They collected about, you know, $300 per spread. And what the insurance that they're underwriting is that GameStop is not going to crash up. And so if it does, then they're going to pay me out 14 times what I paid, which is kind of like, you know, with auto insurance. If you're, you know, if you get into a car wreck, well, I mean, you know, hopefully the premiums you paid in were less than the amount of the car, but, you know, that's not really why you bought the car insurance, to be fair. But it is the reason why I bought this. And so you don't just want to buy these all the time. You have to be very tactical with it and very choosy, very selective. Because most of these trades, I mean, look at the profit probability. It's 18%. So just because it's profitable doesn't mean it's going to pay out 14 to 1. You know, in fact, like it's the odds of it paying out 14 to 1 are pretty low. I put on a very, very similar trade in Tesla. I think it was Tuesday. And it had similar odds, and it's actually doing very well. So let's flip over and look at that. I mean, basically, if Tesla has another down day like today and it holds down near those lows, then this trade is really going to pay out. So, and it might make my week, but maybe not. It just depends on what else is happening. So, let's see here. Tesla. So what I got was the 650, 600 bear put spread. And again, a similar deal. When I put this on, it was priced similarly. I think it was like the ask was around $3. And so it's a lot less favorable now. It's actually trading around 12 or around 12 and a half. And the highest that this spread can be worth is 50. So it's a lot of the way there. So this is kind of, it's pretty far along. and that's great. It's exciting. And if Tesla has any kind of a down, then it's gonna pay off real big. And I don't do these trades in a big way. So right now, this one you can see even as far down as Tesla was today, it's still only 37% chance that it even closes profitable at all. So I call these kind of trades, I call them like this one's more like a 6-inch punch rather than a 1-inch punch. But I mean, sometimes I'll buy these similar kinds of combos at instead of like $3 per spread, I can I'll buy them as low as like 50 cents per spread. And it's even more exciting if you don't have to put it on as a spread. So but let's look at that though. Let's compare it to just straight up buying the option. So right here, the 635 put is trading at 12.25, which is about what the ask. I don't know why it's not showing here, but it says here the minimum investment is $1,263 to get one of these combos, which translates to a $12.63 price tag for this spread. Because it's options, you got to divide it by 100, and so this 635 would be the equivalent thing. And so if I was going to just buy an outright put, here's the chart for that. So if Tesla crashes, it just keeps on going. It goes, you can see that like if it goes to 600, awesome, you're doing great. But if it keeps right on going, you just keep on making money. It doesn't matter how far it drops. You're golden. You just keep on making money. That's for the I don't know why it says the wrong thing here. I think I have to let me clear these legs out. It says the wrong thing, but yeah, this is the chart. Like it just keeps on making money. As far as Tesla drops, it keeps on earning. And so if Tesla drops, it's got to drop even further than 600 in order for this option to be worth more than $50. So right here, if Tesla goes to 588, then this option will be worth, let's put it to expiration. It'll be worth $34. And so, Tesla has to drop a lot further in order for this straight up outright option of the same cost to make as much or more than the bear put spread. So there's a lot of reasons to use those bear put spreads. The place where I don't use the bear put spreads generally is when the expiration time is so close, like 2 days or 1 day left. What you'll find is that like if you look out here on the calls, like see how this is just junk. It's these are 5 cents, 10 cents, 50 cents on these options because they're essentially worthless. And so when you get into a situation where pretty close to the current price, the options are worthless, putting on a spread, like why would you do it? Like why would you cap the gains when that's all you're doing? Like you're not knocking the price off of the option you're trying to buy. And so like if we look back again at this 650, so the 650 itself is $17.60. Well, if I sell the 600, it knocks $5 off the price of that. And so I can buy more of the combo, because it's cheaper. It's $12.50. I can buy more of these than I could if I just bought the 650. And so anyway, that's a great reason to use spreads. And again, it's situational. All right. Well, what else do we want to talk about? Maybe a quick follow-up on MREO. And so there were a couple of stocks that Chris and I highlighted last night. Let's just hit those real quick, and then probably I'll wrap it up. So MREO down today. I didn't take any trades with MREO, but it's on the radar. I mean, I'm really hesitant to take longs when it feels like the whole market's falling apart. Like, even though this was like a really fantastic looking stock, it's hitting this resistance. It's just like, not yet. The chart says not yet. So, and also similarly with the other one that I highlighted. So this was the first one I highlighted, DraftKings, DKNG, yesterday. And if you go back and you watch yesterday's trading homework, the levels that Chris called out on this, I mean, he nailed it perfectly. He drew a line from right here, and it went up and hit that, and that was it. It was lights out, and it was a big down. And so I'm buying calls on this thing, and in fact, like throughout the day, I'm buying what we talked about, the 75 call. Will it hit that in 2 days? I don't know, but they're like 10 cents a piece right now, and they were more expensive than that near the open, but who cares? It's so small that this is really like my 1-inch punch pick of the week, because we're in, even though the chart has some issues that Chris called out yesterday, it's in a blue skies situation, which means that up here near these new all-time highs, there's no resistance on this stock. Like, look at this. When it's up here at 75, there's nobody that's in a loss that's long on this stock. And so if it does get to 75, my thesis is that it can, it won't just stop at 75. Like, it can punch up 30% in a couple of days. And so I went into this in a very small way. I'm not really rushing into anything. Quick update on the ARK stuff too that we talked about yesterday is I have a whole bunch of puts on ARK, and I funded the puts from selling from putting on Iron Condors in ARK. I used that to fund some deep out of the money puts. And so if we do get like a 1987 kind of a flash crash situation here on ARK, which, I think there's actually like a reasonable chance it can happen, although it doesn't have to happen yet, but kind of all the pieces are in place. And so what I'm doing is I'm using the premiums I'm collecting on the Iron Condor and using it to buy deep out of the money. And so let's look at next week, deep out of the money. Okay, because I'm not buying these yet, but probably either by Friday or Monday of next week, I probably will. So let's just take a look at that real quick. ARK. So the reason I like ARK, this is kind of their flagship fund. It's the most liquid one. And super liquid options. It's got weeklies, and it's not as liquid as like QQQ or anything. But all right, so what I'm looking at, and these options are going to, they might be cheaper next week, but I'm looking at the junk. What I want to be doing is picking up the junk, and I want to be doing it not all at the same strike. And so what I might do is something that looks like this. I'm buying a 100 put, a 95 put, a 90 put, and an 85 put as a combo. And you may get it cheaper like that. You may not when you buy it as a combo. It depends. And so I'm not saying I would use these strikes, but this is what I'm looking for when I go in to go shopping, is I'm looking for this junk. And I'm buying this crap with the proceeds from Iron Condors. So let's talk about this real quick. So when I put this in the simulator and we look at, like, say ARK makes a ridiculous down move. Like, this is what I'm talking about. If ARK is down 40% in the next 9 days, then for $1.60 worth of options, or $160 for every $160 sunk into this, ARK, it's now worth like $7,000. So the potential gains from trades like this is big. However, I don't want to just be throwing money away. So what I'm doing is I'm just kind of like averaging into Iron Condors because the implied volatility of ARK, look, it's up a lot higher than the historical. And that's not surprising because it's going down pretty hard. So the implied volatility of 62% is higher than the historical of 48. And the options volume are up, so it's got some liquidity. So let's talk about the Iron Condor real quick. So looking out next week, and the current price of ARK is 124.5. So if I'm in the middle of the trading day, or it's lunchtime, or breakfast time, or whatever, and I happen to look at this, and I say, okay, let's look at an Iron Condor. I'm going to look at, okay, here we are at 124. This level is what we're going to be basing this around. And so what I might say is like, what if I don't know why these prices are missing, so we're going to have to like skip over those, but we're going to sell a 120 and we're going to cap it. So if you don't cap it, here's what happens. Like just selling this, I don't know why it's not showing me that. If you don't cap it, let's just talk through it. So this is half of the Iron Condor, okay? And because these are 5 points apart, it takes a margin impact of $500. And the account gets credited, wherever you get filled at, which is probably going to be somewhere between this bid and this ask. I've been pretty lucky in filling near the midpoint on this. And because this bid-ask spread is so wide, like you're going to want to try and be careful and fill near the midpoint. So anyway, this is only half of the Iron Condor, so we're not done talking about it. But here's my point, is if I lower this to 110, now you see that these options are 10 points apart, and the margin impact is now $1,000, okay? And now let me put this back. Hang on, that might be Chris. Let me check and see. I got a text message. Nope, it's not Chris. It's Micah. She has good news. They made brownies, so I got to go real soon. All right, well, let's just walk through the Iron Condors, and then that'll be it. So I'm going to put this back to where it was. So $500 of margin impact per combo. And because it's a credit, it's showing that here's what the credit is. Now let's add the call side. And so what's nice about this is, hang on a second, let's do the call side. Let's just build it in a very similar way. So we're selling a call that's kind of near the money, and then we're buying one that's slightly further out. And if you notice, the margin impact didn't move, but we're collecting a much bigger credit now. And so if you notice, the midpoint is it's slightly better than the return to risk. Let's see here. Are we thinking about this right? So we're $500 down, and we collect a credit of probably we're going to try and fill near the midpoint, so around $280. And so for every $2 risked, we stand to make more than $1. So that's kind of cool. But you have to like the range on the break evens. So here's the break evens. ARK needs to be above 117.5, and it needs to be below 132.5. Maybe it'll do that. Maybe it won't. But here's the thing: like, if you average in over time on these things and just keep putting them on as the price moves around, like some of those are going to be good, and some of them might not be good. But the point is, I'm taking these credits and I'm using them to buy those out of the money puts, and also I'm using it, those proceeds to buy bear put spreads on Tesla, which is ARK's #1 holding. Well, anyway, I got to end the show here. Thanks everyone for listening. If you liked the video, please subscribe, hit the thumbs up, and share the video, and help me get the word out about this new show. And let's see here. Any comments? Futures down -100. Joe Biden is awful for the market. Yeah, dude, that whole thing is weird, man. It's really weird. Like I'm on Telegram and I follow people like General McNerney on Telegram. So, I didn't vote for Joe. I didn't vote for Trump. I voted for Joe Jorgensen, the Libertarian candidate. Anyway, yeah, help me get the word out on the show. I appreciate it. And I'm at John Tate on Twitter. If you're not following, follow me on Twitter. And we'll see you back